Meet It. We are meeting with Jason Hill and Justin Cambra today. Jason works for a company that helps people leverage infinite banking solutions, but has kind of a twist on it that I was researching a little bit, and it looks really cool. And I'm really excited to have him show us. Justin is a real estate investor extraordinaire, multi-state, all over, almost hundreds of units now. Is it hundreds of units now? But you also do infinite banking. I think you have three different infinite banking policies. And so Justin's going to be here to ask smart questions, and I'm going to ask I don't really know a lot about it, but I'm interested in it questions. And then you guys, if you have any questions along the way, just message them in, and then towards the end, we'll open it up for more back and forth Q&A. Jason, why don't you take a minute, tell us about your company, tell us a little bit about you, and let's get rolling.
Okay, awesome. Well, first of all, I just want to say thanks for allowing me to do this. I have a passion for this, and I love talking about it. For the last 18 years or so, I've owned a marketing company, and my wife and I have worked from home for that time, and I really loved it and enjoyed it. And while I was researching what to do with some of my money, I luckily came across this banking concept, and really as soon as I found it and heard about it, I dove into it like head first. I put my marketing company on hold, and I wasn't taking any new clients for like 6 months until I really could get a very good grasp of this. And yeah, the more I learned about it, the more I felt the need, and I just felt this urge to share this with other people. So thanks for the opportunity. Hopefully you guys learn a little bit here. And I know Justin will help me along the way if he's got a lot of knowledge in the industry too. So it's nice to have him as a backer here. So I'll go ahead and get started if you guys are ready.
Perfect.
Let's do it.
Okay, well, one thing I found in my journey of looking for what like the most wealthy people do is the first thing that they do is they always get their money working for them. There's no way you're going to create wealth or get out of the rat race if you don't have your money working for you. Most of the time, it's very hard for people to do that because they get out of college with a big chunk of change they owe the government for that degree, and then they want to get a house and a car, and they start having kids, so they kind of get trapped in that rat race, and then it's hard for them to get their money working for them once they're spending all of it. So, we try to put a little bit of a twist on this and help everyone get out of debt by using this system and get their money working for them as soon as possible. So, one great thing we can do with the infinite banking concept is recapture and recycle all of your money that you're currently spending right now. So right now, when you get paid from whatever it is you're earning your income from, you put that money most likely in your checking account. And then you go ahead and you pay your bills. You pay your car payment, your house payment, your credit cards. You might take your wife out or your family out for some fun. But anytime you spend money out of your checking account, that money leaves your checking account and it's gone forever. There's no way to get it back unless you do exactly what you did before, and maybe trade more time or sell another property or sell your crypto or whatever it is. You have to do something again to get that money back. So with the infinite banking concept and having your own privatized bank, anytime you put money into this account, that money stays in there forever, earning you interest and dividends. So you get your money working for you. You're earning, anywhere from maybe 4 to 5% guaranteed interest on that money. And then all of the companies that we work with, and most of the companies we know that are doing IBC, have paid the dividend, even though it's optional. They've paid that for over 100 years. So it's not a guarantee, but it's pretty close. We know they're going to pay it because they include that in their assessments every year to be able to pay that out. So some of our clients are getting anywhere from 7 to 8, maybe 9% on a good year on their money. And the best part is that you're able to use the money in 2 different places at the same time. So let's say you started an account with us and you put in, just for rough numbers, $100,000. You put the $100,000 in there, and then a few days later, you can go ahead and access the majority of those funds and use it for something else, all while it's earning that interest and dividends in the background. So you're able to earn on your money in 2 different places at the same time. And I don't know about you guys, but I've never found another tool that allows you to do that with a guaranteed rate on return. So that got me super excited when I learned about that as well. Let me see what else I got on here. You use your money in the 2 places at the same time. So the risk factor, a lot of people ask me about how risky this is. Well, in my opinion, there's zero risk because The insurance companies, anytime there's a financial crisis in the world, the insurance companies are usually the ones that bail out banks and other companies, because when they do their investing, they use AAA bonds and they're very risk adverse. They hardly take any risk with their investments. And they do that because they're restricted by the government, because they know all the money we're putting in these accounts most of the time in this type of policy is our retirement money. So they don't want the insurance companies to be very risky with your retirement money, because they don't want you to lose it. So if something did happen to an insurance company and they faltered, then the state that you're in would actually step in and cover the cost and pay your policy for you. So again, if something happened to that insurance company, the government in your state will back in and have your back. So you are backed up by them as well. So those are just basically some really basic points about the infinite banking concept. Go ahead.
One quick thing. Can you maybe approach it, at least give a quick summary for the people that don't really know where the infinite banking starts? I mean, basically it starts with the whole life policy and how.
Okay. Yes, exactly. Yeah.
Some people coming in are gonna, that kind of, because
right over their head. Yeah, exactly. I got that down on here to talk about. But yeah, so the tool we use for the infinite banking concept is a whole life insurance policy from a company that pays dividends, and they share the revenue with us. So that's where it's all behind, and most financial advisors out there are going to recommend you to buy term. I'm sure you've heard this: buy term and invest the difference. There's a couple problems with that, because the first problem is term insurance. It pays out less than, it only pays out anywhere from maybe 7 to 10%. So the other 90% of people that are investing their money, or not investing, you don't really invest in term insurance, but are putting your money in term insurance, are never going to see a payout on that, like 90%. So that's obviously not a good place to put your money. Also, even people that do put the money in there and then they look to invest their difference, most people don't ever do it, because they just don't they don't ever figure out where to put their money or what to do with it. So all the extra money they could be putting into a whole life policy, it's just kind of sitting there and not doing anything for them. So whole life insurance policy from a company that's paid dividends for like 150 years. Our main company that we used is Foresters Financial, and they work really well with us for the banking concept. And they work really well with us, and they paid a dividend, I think, for like 137 straight years. So whole life insurance policy. Did that answer your question, right?
Yeah, I think that gives a little bit of a rundown for people.
Okay, good. Yeah. So, those are the two main differences within the insurance you could get for a death benefit is term and then whole life.
And then with your role in it, are you the agent, or are you part of the management company? You complement with the agents that are setting up the insurance policy itself?
So I'm licensed agent in, I think right now, 13 or 14 states. And then anytime I find a new client, in a state I'm not in, then I just go ahead and get that license real quick. It's pretty easy for me to do. And then I'm licensed in their state, and then I can help them. So yeah, hopefully at some point I'll be licensed all across the country, and it'll just take a little bit more time, but I'll get there as the clients come in, from different places. So,
and some of the research I've done with it is, and this is something that, I had to kind of educate myself on, was because I would always look at, well, how much am I paying a month? And then what's the death benefit? Right. And I think that's the way most people that aren't maybe educated in how they can leverage the policy in different ways think about it. So then I'd be like, well, $500 a month, I can get that same for $70 a month or $50 a month, right?
Exactly.
And not necessarily realizing that once that $70 is gone, it's gone forever. But the other part, you can actually leverage and invest and do all sorts of things with it.
Exactly.
Part of that too, that is setting up the policy so that it's more focused on the cash accumulation value than the death benefit, and kind of, almost
correct. Yeah, exactly.
If you want to touch on that more than I can.
Yeah, no, I think you hit the nail on the head right there. Just the way you said it was perfect. Most people, when you think of life insurance, it's all about the death benefit. And I'm sure Justin could chime in on this too if he wants. But yeah, and that's something sometimes I have to teach a lot of my clients, because they're like, well, wait a minute. Like you said, I could do term and get a death benefit that's, around the same for a lot less money. But with the infinite banking concept and the way we do the policies, to be perfectly honest, the death benefit is just like a big cherry on the top. The main thing we're trying to do is get you access to your money so that you can put it to work and use it in other places. So the death benefit, we want it. Yes, it's awesome, and it's great when it hits and it pays out. But the real main reason we're doing it is for the cash flow and to give you that ability to use your money.
Not great for the guy that died.
No, doesn't do a whole lot for him, but his family's taken care of for sure. So,
yeah, I think what you guys are talking about is if you've seen life insurance before, you're used to, generally people are used to term, and it's like, oh, it's a couple $100 and you get this $1 million term or death benefit. Some people who have seen whole life policies, they'll look at it and there's a bucket for cash value. Historically speaking, those standard or traditional models have very low cash value.
exactly.
You put a lot of money and you don't get very much cash value. So these models for what they're calling infinite banking are built to where more of the money that you put in there accumulates cash value. So then there's trade-offs for it, because like you're putting in a lot more money, your death benefit isn't as high, but like Jason's saying, it's about getting that cash value. And for those that are real estate investors in here, that using your money in two spots, that's exactly why I did it. And once you really get into it, it's like usually you want to get the minimum just for death benefit, but when you change your mindset, and this is more for investment and purposes, I quickly realized I have 4 policies now, because I'm like, how do I stuff every dollar into the policy first so that I can then pull it out, use it as conceptually, it's almost like a line of credit, to where I can keep pulling it out, putting it into play, having whatever I invest in give me money back to pay off the loan. I'm sure you're going to touch on loans later, but just wanted to, if you've seen whole life before you say, oh yeah, we shouldn't do this, and Dave Ramsey says don't do it. Check in what's there's a lot of people that do infinite banking. It's under different names, but
Right.
You're going to want to look at somebody who specializes in it, so you can see that the numbers and what is built for are totally different.
No, you said you have 4 policies now. What was it just because you just decided you needed more and more, or was it because, is there a strategy behind the 4 different policies, and are there differences in the policies?
There's like three layers to that. So the first one is, yes, I wanted to do more. The second one is I wanted to diversify companies. And then the third one was I treat, the insurance, like Jason would be, for example, say if I do another one, I look at doing one with Jason just because like I get access to somebody who knows how to use the policy. And each of these people that set them up have a unique niche. I have one guy that's like a financial management. There's one that's focused, or 2 that are focused in real estate, and then one who's just like the kind of like the straight up whole life person. So in my mind, I'm doing these other policies with other people so that I have, it's almost like having a round table of
Right.
financial advisors to support me.
And one thing I learned, and this was like the big turnoff for me when I first kind of got a hint of this sort of thing, was like, well, God damn it, it's like $500, $600 a month or whatever for the thing. No one educated me on the part that scares me is the financial commitment, because when you're in an entrepreneur, or I was in commission sales or that kind of thing, you might have months that are leaner than others, right? And I'm like, if I have this commitment that's for air, kind of, right? It's not like a car, it's not a house, it's just the thing that feels good that I have out there, that I have a death benefit for my family, not looking at the other stuff. I don't necessarily, I'm like, that's a big commitment to take, 500 or $1,000 or whatever.
Right.
And so when the money comes in big chunks, whether it's a flip or something like that, being able to put it, there's policies or ways you can set it up where you have more flexibility, and you can throw bigger chunks at it at different times, and sometimes less, sometimes more. Maybe you could touch on that for the people, because the investors that do this are kind of in the same boat, right?
Right. Well, yeah, exactly. And one thing I'll mention real quick for what Justin said and why he probably has multiple, policies now, is because the first one you start out, or anyone you do, you set on an amount you want to do. So usually when we start out small because it's brand new. We don't want them to feel like, we're taking their money and they don't get to use it or whatever, So we start out small, let them use it, get access to it. Then maybe 6 months down the road or a year down the road, they come back to us and are like, okay, I started out with $2,000 a month. Now I'm ready to put more of my income in. And then maybe a year down the road or another year, you're ready to put more of your income in. So yeah, you're kind of locked into the dollar amount that you choose per policy. And that's why most of our clients end up with multiple policies. So I have 3 of them myself. I just added my 3rd one. And I started with my first one. I started for $500 a month. I didn't put anything else in, nothing up front. I was like, this is amazing. I just got to test it first and see how it works. And so that's what I did. And yeah, most of our clients come back with us after using it for a little bit, and they're giddy and they're like, okay, now I'm sick of losing the rest of my income that's not being captured in your system. So let's put as much in here as I can. So that's I wanted to touch on that. So will you re-ask me the question you just said before that?
If I can remember it.
Design flexibility.
Okay, yeah.
You can do it monthly or a lump sum.
Perfect. Exactly. Yeah. So you can pay any way you want to pay, annually, monthly, however you want to do it, you can do it. And I have an example that I'm going to show you here when we go over our specific cash flow analysis that we designed for everyone. And
on that too, can you, what happens, let's say I have a bad year or 2 bad years in a row and I don't fund it or I underfund it, what happens?
Right. Okay. So good question. So basically you have with the insurance company, if you miss okay, let me step back. You have a base in your policy, which is what's the minimum that has to be paid every month, every time you pay. So let's say your base is $12,000 a year, but your policy is $40,000 a year. So the rest of that, that's not the base, would be your paid up additions rider. And that's what we do. The paid up additions rider is where you throw your money in to accelerate the policy and be able to get more access to your cash. So if something happened, let's say you were paying monthly and you had just 3 really bad months in a row. As long as you could pay the base, which is going to be a lot less than your normal premium, then you're fine. Everything will keep going the same. Nothing will change, except you won't be getting access to that money. So if your base is $1,000 a month, but your policy is supposed to pay $2,000 a month and you just pay the $1,000, you won't actually have access to that $1,000 because that's going all to just cover the base. But 3 months down the road, when you get that next flip or you get a big sale or however you earn your income, then you can go ahead and catch the policy right back up. And then it's like nothing ever happened and you're right back in the game. And I believe with Foresters, you have up to 5 years of no payments to actually be able to resurrect the thing and get it back to where you want it to be. So cool. Yeah, it can be stressful for sure. Like you said, having to kind of commit to a big chunk of money and not knowing your future, but knowing that you have a lot of time in there to recoup it and get it back, then you're fine. And really, with the way we design our policies, most of the time in just maybe 3, 4, 5 years, your policy is paying you out more than you're paying in every single time you make a payment or a premium deposit. So let's say, 3 or 4 years down the road, and I'll show you this, but let's say you're doing $1,000 a month. Well, the first month you put in $1,000, you might have access to 700 of it. And then the next year, maybe you put in $1,000 and you'll have access to 900 of it. And then by year 4 or 5, you pay the $1,000 and then you can take out 1,200. And then it just keeps growing from there and there and there. Well, so what I was going to say with that was 3 or 4 years down the road, if you get into a financial situation where you can't pay it, you could go to your bank with bad credit even and say, hey, I have this appreciating asset every year. All I have to do is give them $1,000 and they're going to give me 1,500. They'll do it. And then so you get the money from them, you give them and then you go in and pay it and you pay them back and you have a little bit extra money. So since it's appreciating asset, you could sell it at any time. Once it's in the game where it's really churning out money, you could sell it or just get a loan on it to pay it if you needed it.
And one thing I learned too was, it's kind of common for people to do a big chunk at the beginning of it, like if they have a chunk of cash. And I was wondering, because some people kind of maybe would do this instead of an IRA or something of that nature, does anyone ever like take, cash out their Roth IRA and then just decide to throw 100 or 200 grand at the beginning of one of these to get it rolling?
Absolutely. Yeah, we have that a lot. I have a lot of people with their 401ks that just rip it out and even take the penalty because, I'm not going to get into 401ks and tell you why I don't think they're a great idea, but I will say this, the inventor of the 401k, he has $0 of his money in it at this point. And he said, it's not now what it was designed to be. And he has 70% of his money in this infinite banking concept. And he's the one that structured and came up with the 401k. So that's not my word again. That's just, his word and what he's doing with his money. So I can't think of his name right now. I could figure it out for you and then get that to you. But yeah, it's the guy that designed the 401k. He just said, at the beginning it was kind of what he wanted, but it has evolved to something that's not now. And, one of the worst things with the 401k, in my opinion, is the deferred taxes on it. When you start out and you're a young whippersnapper making, $24,000 a year, I think you'd rather pay taxes on that money than when you're down the road, hopefully in your retirement years, making $100,000 a year. So they're going to tax you on a much bigger nut later in life. And at that point, you're really not in a position to probably pay the taxes. You have no time to make it up.
Ted Bennett.
Ted Bennett. There you go. Yeah. Thank you. Yep.
Yeah. I just posted a link to an article that popped up. That's what you're saying.
Yeah. That's the article I read about.
It works better when you're like, you have the name and you're like, well, there's a guy. And
yeah, I know. There's some dude, he did it. It worked.
He did a thing.
Yeah, Ted Bennett is the guy. Yeah. I don't know how he got that contract to do it, but he's the one the government picked to design that 401k. So let me talk about this real quick while we're still on the IBC. And I know Justin probably, are you familiar with a MEC contract? I know we kind of discussed this back and forth a little bit, but you don't understand what that is. Okay. So
modified endowment contract. Yeah.
Modified endowment contract. So back in the late 80s and early 90s, the infinite banking concept was taking off big time and people were making huge amounts of money. And of course, our big bad government that doesn't want to see everyone too successful came in and said, hey, you guys are making too much money with these types of policies. So we're going to put this imaginary line in there, which is called a MEC line, the modified endowment contract. And if you go over that line, anything you earn from this policy, we're going to charge you as a capital gains. So when you're designing these policies, you have to design them carefully so that you stay below the MEC line. If it ever goes MEC, then forever, the rest of the policy, you will always be paying capital gains taxes on all of your money that you earn from this policy. So, but the way that it's set up without the MEC is that, let me talk about the loan part since you mentioned it, because that ties in perfectly well with it. But when it's not a MEC contract, it's a regular contract. All of the earnings that are coming from this are tax-free growth. You never have to pay taxes on this money because it's all tax-free growth. And so the way it works is with the loan, let me touch on that real quick. When you put your money in here and you go to take a policy loan out and request some money, you want to use your money to buy a house or a car or whatever it is. So you go take a policy loan. What happens is the money that you deposited actually stays in there. You're never actually taking out your own money. You're borrowing from the insurance company's general fund. So it's a policy loan. Now there's two huge benefits to that. The first benefit is your money never leaves. So you're getting uninterrupted compounding interest forever on that money. That's the first big benefit and why it's designed that way. The second benefit is since you're taking a policy loan, that's why there's no taxes on any of the income that's generated, because to the government, it's a loan and not income. So the loan with foresters, and they all vary from maybe 4 to 5 or 6% on your loan. But with foresters, it's a 5% daily simple interest. So some people get a little scared by that number and be like, wait, I have to borrow my money and pay interest on that. But the thing is, it's daily simple interest, and 90% of our clients have debt somewhere else that they're paying a much higher interest rate on, whether it's a car or a credit card or their house. And none of those are simple interest. Those are all very complicated things where at the end of the day, you're paying way more than your pretty 3%, note says on your house at the end of the day, because you're going to pay double in interest charges, by the time it's done. If it was daily interest on that, it wouldn't be the case. So you're not really getting 3% on your house if you look at the numbers. It sounds good, but that's not what you're actually getting. But with the daily simple interest charge, it is actually what it sounds like. Every day you're being charged a simple interest. So let's just use this example. Let's say you took out $1,000 on a policy loan and you used the money for 6 months. You would be charged 2.5% interest on that money because it's daily. So it just adds up. So if you're there for 365 days with the loan out, then you'd hit the full 5%. Does that make sense?
Yeah, I think so.
Okay.
So is this because I believe in like the normal like IBC stuff, you basically can set it up so you're borrowing at whatever term you want, and you got to pay it back eventually, right? And like, so is this because it's your guys' product where it has the interest part, or maybe
Well, no. So all policies are going to have that interest, but you're right about setting up the loan term. So this is something that you never have to pay back if you don't want to. Now, we obviously tell you that it's best interest to pay it back, because if you go get a loan from the bank, you're going to pay them back. So we teach you to be a good banker and pay yourself back with interest. So that's why, it works out way better, because you're getting the interest yourself. You're paying yourself the interest back.
Okay. Okay, cool. So that's going to the policy or the account, not the foresters or whatever. Like, it's not like
right. It's all every dollar you put in is going to build up your death benefit.
Okay.
And your cash value.
Okay, cool. Yeah, that works fine.
Yeah. So, and like I said, most people have maybe 12% interest on their credit cards or something else. Mm-hmm. One thing that we specialize in that a lot of companies don't necessarily do is, once we get a client, then that's kind of when our job starts. We have an amazing mapping process. And so what happens is a client comes, and we do this for free. We were going to charge like $3,500 for this service, but we decided just to give it to every one of our clients. And so when someone comes on board with us, then we're going to sit down after the process, and we're going to go over all their bills, all their assets, everything they have. And we're going to design a plan on how to use the bank that they just started to pay off all that debt and get out of debt. So we're going to accelerate that process, get them out of debt, get all that debt paid off. And then once they pay that debt off, then they can just continue making those payments to themselves with interest. Mm-hmm. So
interest is a lot less painful when it's going to you.
Yeah, absolutely. Then you're like, wait, can I pay myself 20% interest? I get that a lot. People want to know how much they can pay themselves. So you can't go crazy, but it is up to you. But you can't go crazy. They're not going to let you pay yourself 100% interest. Like I said before, it's all, once you kind of decide on an amount, you kind of really got to stick around that. If you said I wanted to pay $1,000 a month, but you had $1,100 one month, you could probably do that and get away with it, but probably not every single month. So there's a little leeway, because they do know you're going to pay yourself back with interest.
Cool.
So, okay. Any questions, Justin? You want to bring up anything on the banking concept or anything? I was going to jump into, well, actually, yeah, let me go over the cash flow analysis. Did you have anyone want to bring anything up before we look at those?
All right. Question time. What we got? Corey, do you see that on your end? Do you see that?
I see Corey's question. Yeah, how did it? So that's a good question. That is all designed in our software. So I just know when I click a button and a red thing says it turns into a mech, I know that's not good. It could be, because we actually do design a lot of policies to be a mech policy, but I'll explain that when we get to the trust. So Justin, do you have any comments you want to add in real quick or anything at this point?
I'll just hop on real quick on, you're talking about the loans. So the loans, you can pay back however you want. Yeah, like you're saying, theoretically, you don't pay them back. But what I do is I use it for like flip projects. And then when the flip project's done, if it's 6 months, I don't have to make payments. So then I just go 6 months, I get the money, and then I put it back into the policy. The 5% that is charged, that doesn't go to you because you're borrowing it. Now, if you choose to pay on anything higher than that, that can go into your actual policy cash value. The maximum amount that you can do is a function of what the MEC limit is. So like you could pay yourself 10%. So 5 goes to
the company,
and then the balance would go to your cash value, as long as you don't hit your max contribution.
Correct. Yep.
How anal do you have to be when you're pulling the money out, doing a flip, with the accounting, with where the funds are going and accounts, or like, I'm guessing you have to get like a separate account set up or an EIN number or something for the I don't know, for the policy, or how does it work?
For what I do is I do have a separate account that is solely for the ins and the outs of the policy. And this goes back to what Jason was saying about mapping. If you put it into a separate account, it's easy to see what went in and what went out. Right. If you put it into your regular checking account, you got ins and outs of tons of stuff. But like in this one account, like it's very few transactions, and it's either coming from the policy, going to some investment, investment back into the account and then the account back into the policy. So it's a much more simplified, easy to track process.
That's good. I like it.
Great. Yeah, that's a great point. We definitely recommend that to all of our clients. Once we get to that point, we're like, hey, just go ahead and set up a new account, even if it's a savings account. Because like you said, it's just so much more transparent and easier to see where your money's going. Yep. All right, cool. I'm going to try to share my screen, see if we can do this. Okay, well, let me know when you guys can see it.
We got it.
Perfect. Okay. Okay, so you guys can see this cash flow analysis, correct?
Yep.
Okay, perfect. So we do this for all of our clients. And basically this is just a really simple way to see the money, how it all works in, when you get an illustration from a insurance company, there's, they're usually 17 to maybe 30 pages long, lots of fine print, lots of small print. It's not easy to, exactly see what's going on. So we break it down really easy here for you to see it. Now, one thing I will mention is that you can see right down here, it says this total net cash value includes non-guaranteed assumptions. So just want to be upfront with you that this does include the guaranteed rate of return that you're getting from the insurance company and plus the dividends. And we just use an average dividend, which has been, we use the average that we've had over the last 10 years, which has been like 5.1 or 5.2%. So these numbers aren't necessarily guaranteed, but I mean, it's really close to exactly what you're going to end up with, but you will use the policy differently than it's set up here too. So the more you use it, the better returns you're going to get, because the more money you're moving in and out, it's going to lock more of that money in for you and you'll get better returns on it. So let's start out with this one here. So this is a younger gentleman. We'll go over all the different columns here so you can see what we're doing. So just policy year one here. This is how old the insured is. This gentleman here is 22, so he's happy with life because he started super early. His premium for the first year is $10,600, and what he did was he's doing $600 a month, and then he put in $3,400 one time. So that's where we get to the $10,600. This column here is your cumulative premium. So this is just how much money you've put into the policy over the life of the contract. This is the big one you really want to pay attention to. This is your total net cash value. So this gentleman, he's going to put in $10,600 the first year, and he's going to have access to $8,527. So, I mean, that's 80%. That's a pretty good policy. Definitely a pretty good policy. We try to get you right around 70% minimum. And sometimes if you have a big chunk of money to pay in, we can get you much higher return the first year. But so he's getting 80% the first year to the money. And one thing I want to point out about this is just because he's not accessing the additional 20% of his money, it doesn't mean it's gone or it's not working for him. It's all in the background working for him, earning him interest and dividends. He just can't touch it the first couple of years. This column here is your yearly cash available. So this just breaks it down on a yearly basis about how much you're going to be able to access. This column here is your return on investment in dollars. And this is your return on investment in percentage. And then here's your death benefit. So let's talk about a couple of these real quick. So I told you here in this first year, he's getting 80%. So he puts in his money and he gets to take out 80% and use it forever, whatever he wants. From the very first day he makes his first premium deposit, he's going to have an increase in his wealth by $666,000. Which will go towards his, how much he's worth, his net worth. Let's go down here to year 5, because this is the first year. There's 2 break-even points in this policy. So the first one is going to be your percent accessible break point per year. And then over here is going to be all total of the policy. So just in year 5, the policy is already going to be paying out more than he puts in. So again, he puts in $7,200 this year, and he gets access to $7,800. The next year, it just keeps getting better and better and better, as you can see. And then if we go down here to year 9, this is when we call basically the total return on investment is now in the positive. And again, all this money is still working for you in the background, even though you can't access all of it. But by year 9, he's going to have access to every penny you put in plus more. So This year he puts in 7,200. He has access to 9,520. That's a return on investment of $2,179, which is 3% on the policy. And at this point, he's up to over $1 million death benefit.
Talk to me about year 11 and why the death benefit drops 300 grand.
Great question. That's exactly what I was going to touch base on next. So the reason you see this dropping point here in the death benefit is because every policy that you design, you have to use, well, basically everyone uses a term policy inside of the whole life policy to be able to pump more money into it. So we use a term rider to actually be able to stuff a bunch more money in there to increase the ability to access the cash. So in the first 10 years is the term rider. And then after that, that term rider falls off. So your policy will drop down in your death benefit a little bit there because you're not paying that money that goes to the term benefit anymore. Does that make sense?
Kind of.
Okay. And so with our trust, we don't have to actually use term at all with it because we can actually make it a MEC contract. And I'll talk about that here in a little bit. But let's go down here let's just go to year 20, see where we're at. So year 20, he's still putting in a little over 7,000. At this point in the policy, he's put in $146,590. He has cash available sitting in his account of $209,286. This year, in year 20, every dollar he puts in, he gets back $2.18. So he puts in $7,100 and he gets out $15,545. At this point, just 20 years in, he's profited $62,000. And that's a return on his investment of 43%. And now he's back up to over $1.1 million in death benefit. Well, let me go down here to retirement years so you can see it. Because most of these policies are really designed for you to have tax-free income in your retirement years. And as you can see, let's just go. This is a nice, easy one to look at. Age 76. So at age 76, he's still depositing $7,000 a year. He's paid a total into the policy of $395,000. And this money here, this isn't extra money that he has to go out and make or additional funds or anything. This is money that he's just currently putting into his bank account and spending, but we're just directing it over here first before he spends it. So he's put in $395,000, almost $400,000 of his own money. And now he has access to $1.4 million. For every dollar he puts in this year, in year 55 of the policy, he gets $8.63 back. So he puts in the $7,000 and he's got $61,000 sitting there that he can access, which is about $54,000-ish in tax-free return on his investment. He's made over $1 million in the policy at this point. His return on investment is $274,000, and he's got a $2.3 million death benefit.
That's awesome for a kid that's 22. Do you have like something like this for like, I don't know, someone in their like 40 or that kind of thing? Just kind of
yeah, I've got another one here for someone that's 30, and I could even pull up another one if you wanted to see it. But let me go over this last bit here. Wow, look at this here. So this year at year 81 or year 60 of the policy, my client, he'll be 81. He's going to put in $1,700 per year still. It's dropped down now. You can see from the 7,000 to the 1,700. He's put in out of his own pocket $425,000. He's got $1.8 million in cash value that he can access. This year, look at this. Every dollar he puts in, he gets $36 back. So he puts in $1,700 and he's got access to $62,000. Now I want to explain this because this is something that's a lot of people can get a little confused on. We talked about before about paying it back. Really, paying it back is optional. And again, we definitely recommend it and we want you to do that. And that's the smart decision. But let's say you get down here to you're 81 and you're like, hey, I don't really want to pay it back anymore. I just want to use the money and live on my retirement money. And, I'm not going to pay it back. Screw it. What would happen is let's say he went ahead, my client here, and he spent all $1.8 million that he has in the account and he didn't pay it back. And then he passed away. What would happen is over here, he has a $2.5 million death benefit. So all that would happen is when the insurance company goes to pay the death benefit to his beneficiary, they would just subtract out the $1.8 million that he spent and still pay the beneficiary around $700 or somewhere around there, $1,000. So look at that. He's only used of his own money, $425,000. That's all he's put in out of his own money. And again, that's money he's already spending and using. It's not additional money he had to go make. He spent $1.8 million doing his thing. And then when he passes away, his beneficiaries will still get $600,000, $700,000. I mean, that's pretty incredible. And so, okay, so that's it on this one. Anyone have any questions on this one? I can't see if the questions are coming in right now since I got my screen up, but if you see any, just holler.
Nothing's popped up.
Okay, great. All right, well, let's go ahead and look at the next one. So this one is a little bit younger person too. She's 32, and they're going to do the very first year, 99,000. So what they're deciding to do is they're going to sell off some of their crypto, about $100,000 worth, and they're going to put it in here. So what they're going to do is do a yearly policy annual of 24,000, and then they'll do 75,000 or 75,000 one time. So I'm going to show you how big of a difference that makes when you do that. Look over here to your percent accessible in year one. Now he has they have 90% access to their money, which is unheard of really in IBC. I don't think there's very many companies that will give you that much access. But I'm sure you can find it if you looked hard enough. But that's the main goal. We try to just give you as much access to your money as possible. So you can see they'll have access to the 89,000 out of the 99,000, and they'll start out with the $1.4 million death benefit. And let's just go down here to retirement years, since you already kind of seen one, to see what it looks like. But you can see here again, in the retirement years, in your 80s and 70s to 80s to 90s, the insurance company that's when they're going to pay you the most amount of money for your money. So for every dollar you put in, they're getting over $20 back per dollar. So 50 years down the road, when this client's 81, they're going to put in $7,800. At this point, they've put in $1.25 million of their money. Wow. They have access to $4,300,000. Again, they're getting $20 per dollar that they put in. After they put in that $7,800 that year, immediately the next day, they'll have access to $160,000. They'll have profited at this point over $3 million, which is a 240% return on investment, and they're sitting at $6.3 million death benefit.
Is the 24 grand, is that the base that you were talking about earlier, or is there a different number?
So that's the base plus the paid up rider. So I believe in this policy, without looking at it offhand, I believe the base is around 9,000 per year, I believe. So, and again, the base is just the minimum that you have to pay, and the paid up rider is what we throw in there to get the acceleration on the policy and to give you more access to your funds.
Okay.
So just real quick, if this person, again, when they're 80, decides just to spend all of their money that they have here, the $4.3 million, again, that's fine. That's no problem. When they pass away, they'll subtract that amount, and the beneficiary is still looking at $2 million to go to them. So they spent $6 million or $4 million. The beneficiary gets $2 million, but they only contributed $1.2 million in their entire life of the contract. So, any questions?
He's showing you a $7 million death benefit. No questions? Come on.
Someone say something. That's exciting.
Yeah, I was just curious.
Awesome.
So I'm just kind of trying to ascertain, right, of course, where that money comes from, right? Because you're getting more money than you put in.
Correct.
Is it, I don't want to say pyramid scheme. I know it's not a pyramid scheme, right?
Right.
But is it reliant on those people in the earlier years who are they don't have as much in?
No, not at all. It's not tied to anyone else or anything. The way that you're able to get your money is because when you give your money to the insurance company, they turn around and invest it for you.
Right. So it's just the compounding returns on
Correct.
that money.
The reason that we're looking at a $6 million death benefit now is because the uninterrupted compounding interest. Compounding interest is amazing, but if you get uninterrupted compounding interest, there's nothing that can beat it. I mean, if you were to run a bunch of numbers and just look at, some years where it wasn't compounding, you'd see a huge major difference. So yeah, it's
Right.
just, they're very good at making money on your money. So, and like I said, they're very limited by the government of how they can invest your money. They have to be very risk adverse. They have to be very, good with it. They can't take any kind of risk really.
And then I guess the follow-up would be, you take out the money, the loan, and not pay it back or whatever. Is there, without that MEC, before you hit to the MEC contract, is there a taxable event at all involved in, let's say you took out whatever, the $1 million?
Correct. No, there's never, the only time there would ever be a taxable event is if your policy hits a MEC, which if you don't have the trust, we would not allow that to happen. So, and even if you messed up and sent the insurance company like a check for too much money and it was to cause a MEC, the insurance company is going to just send that check right back to you and be like, you can't do this because this will mess it up for you. So they've kind of got your back as well. They know they don't want that to happen for you. So normally the policy will never MEC.
Okay. And so this is basically the infinite banking portion of it. Right?
Correct. This is pretty much your traditional banking, infinite banking concept with which, of course, I feel like we try to give people a little bit more access than most people. I mean, I don't know if how much you were able to access, Justin, if you remember even in your first couple of years. Do you have any idea maybe on some of your policies?
I bet he knows.
So on the first one I did, the policy was had more weighted towards base.
Okay.
I think so. My first policy, I do 50,000 a year lump sum. I think I had 35,000, so call it 70%.
Okay, that's not bad, especially if a lot of it was towards the base, for sure.
Right. And so then the other ones I did are that was with Penn Mutual. The three other ones I did are with Mass Mutual. I'm getting close to, I think it's around 90%. So put in 50, getting. Yeah.
Okay, awesome. Yeah. So, I mean, you probably did put a pretty big chunk in on those, I'm assuming, for the paid up rider to start it out.
Yeah. The base versus paid up edition, the ratio is closer to 10% base, 90% PUA.
Wow. Okay. Awesome. Nice. Okay, cool. Well, yeah, thanks for adding that information in there. It's nice to have a living example using it too, other than just me. So appreciate that.
Okay, so now, I guess, unless, is there something we want to add here, or do you want to now take that transition to your guys' what you guys do on top of that?
Right. Yeah, let's do that. Let me answer this question. I think Sandra just asked a question about taking it out. Yeah. So anytime you take funds out, you will take it out through a policy loan. So you could take your money out, but that really defeats the purpose because then you're not getting your uninterrupted compounding interest. So, and then it most likely would be a taxable event if you take out your own money. If you're, down the road and you've earned a lot of money on that. So
just maybe to clarify on that point, when you put the money in, you get what's called cash value.
Right.
You can take a loan of the cash value. Now, if for whatever reason you just wanted to take the money out, then you're basically like closing out, you're taking a withdrawal. Then there's I don't know if there's a tax event on that or not, but the cash value, that's what you can do loans in and out all the time with that money.
Exactly. Yeah. The cash value is where it's at. And, the reason the insurance company is doing this and they're allowing us to access our money is because of the death benefit, because they know from day one, once you sign up, you have this big death benefit that they owe you. So they're going to let you kind of use some of that money for now, because they know if you never pay it back, it's okay, because they're going to get it when that happens, when the death event happens. So another question just popped up, but I didn't catch it.
So how long does it take to get the loans out or access the money?
Okay, great question. So the very first deposit you make, it's going to take about 5 business days to be able to access the money. That one takes a little longer just because it's the first setup, and a lot of times with the big chunk of money, they want to make sure all of it hits before they give you access to it. In general, after that, I'm able to access it the very next business day. So for one of my policies every month, I told you I pay $500 on the 15th of every month. On the 16th of every month, I go into my account, do a policy loan, and the money's usually back in my account on about 3 business days, almost perfectly every time. So, and some people's banks are a little different. They might be a little faster or a little slower, but generally I would say 3 business days is pretty accurate.
So can I clarify something that Ryan said before? He was asking how meticulous you have to be with your record keeping and everything. We have to.
Sandra knows exactly why I asked that.
Yes, Ryan doesn't like to keep receipts. So if I understand it right, and please correct me. So you have the whole life policy in your own personal name. You take out a loan. And then you have your LLC that you, let's say, flip your houses. Then you give the LLC a loan. The LLC borrows money from you as the person, does whatever they do to flip houses, and then pays you back as the person, and then you pay back the loan to the whole life insurance. Is it correct?
Pretty much, yes. Yep.
Okay.
Yeah, that's how it would work.
So Ryan, you would still have to keep your bookkeeping, right, for your LLC?
I walked away. I didn't hear any of that.
You don't want to hear it. She said you got to keep some bookwork, but yeah, it's really very simple because really you're only going to take access to the money usually. Well, if you're like a monthly person, you'll take it monthly, most likely, and if you're doing annual, you can do it throughout the year, but you usually aren't doing it so often that it becomes a headache. I mean, maybe 3 or 4 flips a year you might want to use it for something. You can use it as pretty much as you need it, but most of the time you're not using it that often, just on your projects that you need it for. So it's not like a daily or you got to go in there and mess with it 5-10 times a month or anything like that. It's a pretty simple process. That answer your question?
That's what they all say.
I said pretty simple. No, it's pretty easy. Yeah.
It depends on the company. So with Penn Mutual, I've got to sign a document and then fax it in, or not fax, but scan it, email it to my advisor. They process it, and then it takes maybe a week. With Mass Mutual, there's app-based. I just click the buttons, and it's like 1 or 2 days.
Yeah, we went through that too. Yep, when we first started our company, we had to mail it, not mail in, but, we had to print it out, sign it, scan it back in and get it to them. But now we have everything set up through DocuSign. So it's pretty much like the app. It's real simple. You do have to sign something every time when you take a loan out. And that's just because they want your signature saying, what you're doing, and, to get your access to your money, they just have you sign the form. And it's a simple process. Like I said, three business days, you should have the money back in your account.
Sweet.
Okay. If we don't have any specific questions for infinite banking, which we can ask those again in a minute, I'll move on a little bit to the trust and talk about really, in my opinion, what separates us from anyone else out there in the field. So let's talk about the trust. So we have, and this is the only reason we really have this trust and we can offer it is because we fell into it. We started getting around some clients that had a lot of money and just knew a little bit more than us. And we ended up learning about this trust. And this trust is different than 99% of the trusts out there that you see for a couple reasons. So the first thing is this trust is a non-grantor trust. What that means is someone else other than you is going to put this thing into existence by contract, through contract law. They're going to set it up for you. And then they actually will sign it over to you. They'll sell it to you, and then they will retire and sign off from it, and they won't have anything else to do with it. And at that point, the trust becomes its own entity. So if you go to your local lawyer or trust shop down the road, they're going to tie it to your social security number. It's going to probably be a living trust, and really it's going to be considered by the IRS an extension of you. But with the trust being a non-grantor trust, it's its own entity. It can have its own EIN number. It can have business credit. It can do everything. It can do everything an LLC can do, except it can't be licensed. So since I'm licensed insurance agent, I can't actually have my trust be licensed and get paid for me. So there's just an additional step I have to go through since I'm licensed. But it's not a big deal. So that's one thing that separates the trust from most other trusts. The second thing is this trust is discretionary. And what that means, most other trusts, you're kind of set up from the beginning, who gets paid and how they get paid and when they get paid and all this stuff. But with a discretionary trust, the trustee has all power over that. They can decide when and where a distribution is made, or they just decide everything about the trust. So the trustee is the most important person in our trust. The first biggest thing, obviously, with most trusts, especially this one, is the asset protection. So once you sell all of your goods to this trust, then you won't own anything. You'll control it all. Like Nelson Rockefeller said, you don't want to own anything but control everything. So this trust is basically what he was talking about. The Rockefellers have had this specific trust in their family for a very long time. And they have, I think right now, like 52 or 54 families that are all in this one family trust that they have, which is crazy. Because imagine all those people, anytime a death benefit happens, anytime a death in the family happens, just a chunk of change gets deposited right into the trust. And then they turn around and buy more insurance with that and just keep it churning. So,
Jason,
yeah,
I hate to do this for you. I just wanted to say, so we're about an hour in at the time, and I know we're rolling into the trust, which is kind of the meat and potatoes of what you guys do, and it's definitely the biggest value add to it. So I haven't gone through this part of it. I wanted for everybody else to know, is this something that you think we might want to do into a second, like a volume 2 of this, basically breaking up the infinite banking in this, or is this something that you think it would make sense at this point in transition, into the rest of it because of everybody's time and everything?
I would say if you guys have maybe just 10 more minutes,
okay,
we could probably cover everything. And the thing about it is that they just tie so well together, and that's why we started offering it, is because when you combine these two things together, it's just an amazing event that happens.
Awesome.
So I'll try to keep it quick, but yeah, really, I only have a couple things to point out about it. And the first one was the asset protection. So anytime you put something in here, this thing's like a titanium vault. It's a spendthrift trust. It's never been cracked by the government. No one's ever ripped anything out unless there was an illegal activity.
And you're still presenting too. I don't know if you have something you're going to show us on screen.
Okay. No, I don't really have anything to show you on this one. I'll show you these books I have here in a minute. But so the asset protection is the first key with the trust. And then the second one, which is, our favorite for most people, is it's not subject to capital gains taxes. So most of our clients are real estate investors and they're wholesalers. And, with this trust, you could buy a property, wholesale it, sell it 5 minutes later and not be subject to any capital gains taxes. So, obviously that's a huge deal. A client I just met with yesterday, and we talked, he was about to pay $100,000 in capital gains taxes, but now we're able to get him the trust and he's going to be able to keep every penny of that. So also it works with other types of income as well. The only type of income it really won't work on is W-9 income, because you're kind of tied to that employee. They're taking your taxes out usually before you even get it. Can't really have write-offs with a W-9, so it's not much they can do. But all other income, we can defer into perpetuity for you with this trust. And there's really never the need to have a taxable event. So when you tie the two together, we call it Vortex Banking. And basically what you can do is the trust can own the insurance policies. So with that being said, you can actually buy life insurance, our type of banking policy, with pre-tax dollars. And I don't know of any other tool, maybe someone can enlighten me, but I don't know of any other tool where you can use pre-tax dollars to buy this type of life insurance policy. So really, if you're using pre-tax dollars to buy it and put all the money into it, and then there's no tax event ever, it's all just pre-tax dollars just moving in and out. Does that make sense?
Sandra, do you have a question on this specifically?
No, not yet.
Okay.
Not yet. Okay. So yeah, that's really the gist of it with the trust. Just, there's a lot more details, and it's a little bit more tricky, but the main two positives are there's asset protection better than any other trust. And then, I don't think we all work hard for our money, so I don't like giving it to the government. I think I spend my money better than they do, but, they might disagree, but I'm going to try to keep as much of my income as I can, So that trust is the winner, breadwinner in that bad boy. So that's why we decided to use the trust. Our main product is IBC, is the banking concept, but with the trust tied to it, it just makes it such a phenomenal product. So lastly on that, we talked about the MEC line, and that's why this MEC line is important. So with the trust, since it's not subject to capital gains taxes, we can actually design a MEC policy. And we purposely do that if you're going to get a trust. And the reason that's big is because you don't have to buy the term insurance. So when you buy the term insurance in the normal banking policy, you know, you're going to spend maybe a few $1,000s or maybe more that goes towards that term, and you're not really seeing the benefit from that inside of your cash value or your death benefit. I mean, you are getting it with your death benefit, but not really with the cash value. So with a MEC contract, it's gonna be much more efficient. It's gonna work better. You're gonna have more access to your money faster, and it's just gonna be a much more efficient policy. So we designed it to be a MEC, and then at the end of the year, the insurance company is just gonna send the trust the capital gains, you know, receipt and say, hey, this is what you owe, and the trust is gonna say, well, we don't pay capital gains taxes, so thank you anyway. But and so that really is the big caveat, is how you can do it. You can use pre-tax dollars. You could use a MEC contract, which is much more efficient. And like I said, before the MEC happened, the policies were a lot more efficient back in the day. And then the government said, you know, people are making too much money on it, so let's put this invisible MEC line in. So if you don't have a MEC, or if you don't have a trust, we would never design you a MEC policy ever. That's not a good idea. But with the trust, we can do that, and it's very beneficial. And really, I think that's all I was going to talk about with the trust. And I'm happy to answer any questions, because I know you probably,
So I know. Okay, so walk me through this. You're the agent of the company setting up the life policy and everything, right?
Yes.
You have this other dude who's setting up the trust, or that kind of
So
thing.
our company has the copyright on the trust as well. So we have a copyright, and inside of the copyright is the tax code 643.
Let's turn off your presentation things. It's like, so we can
Okay.
actually get the faces. And
Well, we can turn it back on here in a second then. Do I need to turn it off?
Yep. Stop sharing.
Okay, yeah, there we go.
There you go. Perfect.
Okay, perfect. Well, I can see you guys, but you might not see me. So, okay.
So yeah, so you have the dude, and you got the copyright and like things. So walk me through this like layout and stuff, and then also for me, and this is along the same lines as the like record keeping and all that stuff, is with trust. You get the signing as trustee and all these different things and all sorts of stuff and legalities and just annoying little like procedures and stuff. I'm just kind of curious, what do you have? Like, what things do I got to go through, or does your expert or whatever handle it? I click a button and it happens, or are there like procedural things I got to really like deal with?
Well, yeah, that's a good question for sure. So our company, we specialize in the infinite banking, and then we found the trust. So now we added that as our second product. Those are the only two products we offer. We have the copyright on the trust, and the tax code is written into the trust right inside of it. So it's all, legit. And then we have Richard, who is our accountant. And so he's the one that we found that was using this trust he's been using it for the last 29 years. He just filed his 10,000th tax return using this trust, and he's never had an audit or never had up any red flags. He's actually of course I'm not going to be able to think of the term right now, but he's a licensed agent through the IRS. Now they don't do that anymore, but he's been doing it for so long, like 20 years ago, maybe 15 to 20 years ago, they had a program through the IRS where they would actually not license, but add you, as one of their preferred people or whatever. They don't do it anymore, but he's still grandfathered in. So he's the one that would handle all of that with the trust. So we'll help, I explain it to you. And then if you had a specific question about your business, then we would just get on the phone with Richard and he could answer that for you. So it's actually pretty easy. And let me say this about the trust too, that separates it from the other trusts. Most trusts operate under legislative law. All the laws Congress puts in there, they have to abide to. This trust, the IRS did not help get into existence. This trust was made by contract law. And, that's our constitutional right, is to use contract law. And so that's what really separates this trust from all other ones. And since it's contract law, it's really easy. All the contracts are built into the trust book. And I just looked, I'm selling my house to the trust here in the next couple of days. And I looked, and it's just a 2-page form. The trustee signs. I sign it since I'm selling my house, and it's just a few signatures, and it's a really simple process.
You keep saying this trust. Like, what's the trust called or whatever?
So this is it's a non-grantor discretionary spendthrift trust.
Okay.
And yeah, and there's a few other words in there that mean stuff too, but those are the two major ones.
Yeah, and that's the specifying kind of part helps too. But
oh yeah, for sure. Yeah, it's a non-grantor discretionary spendthrift trust.
Okay. And so, talk to me about, are there month or annual or whatever, like management fees, or like what kind of things go with that and having the policy? And then Justin, maybe you can chime in and kind of say, is that something similar, or is it, different to what? Because I know adding the trust probably adds another layer of some sort of cost or fees, I would assume.
Well, the trust has a one-time cost of $12,500.
Okay.
One time. And then if you want, in the first year, it's going to include Richard. He's going to answer all your questions. He's going to teach you how to use it. He'll help you get all of your assets into the trust. And then if you have an accountant you currently use, he'll teach your accountant over that first year how to use it for you. And that's all free with, it's not an additional cost. If you want to use Richard going forward, it's just $1,500 a year. And that includes your personal taxes he's going to file for you, your business taxes if you have a business, and your trust taxes. So I mean, that really is pretty low price compared to what a lot of accountants would charge for it. And we know of 2 other companies that sell this trust. So there's 2 other places that you can get it. One company sells it for $40,000, and the other company sells it for $100,000. Which still $100,000 for a lot of my clients would be a phenomenal deal, because a lot of times they save over that in the first year in their capital gains taxes, or their other taxes that they're having to pay. So, but we know how much it costs, and since it's not our main product, we just tie it in with the banking. We don't feel like we have to make a tremendous amount on it each time, so that's why we're so low on that price.
Gotcha. Okay. That's good. And what were the books, or what do you want to show the people?
Oh yeah, I just had a few books that we'll go over. Let me bring it back up here. So this one, I'm sure Justin's probably read this one. Well, let's see. Here, this one is Become Your Banker by Nelson Nash. And he's pretty much the grandfather, the godfather of the infinite banking concept. And this book's, I think it's probably 60s, maybe, I believe was written in the 60s. But this book is great. It'll show you a lot of examples and show you a bunch of really cool things how to use this. And then there's a bunch of other books too. These are all books I have right here, and I have the Nelson Nash one too, but I've got it loaned out. So this first one up here, The Unveiling the Secrets of the Rich by Josh Nelson, he's actually the owner of the Infinite Wealth Strategist of our company. And so this book specifically talks about the way we do the banking policies with our trust. And then the other ones talk about the banking concept, and like Justin mentioned earlier, there's other people that do this, and there's just different names for it. Like these gentlemen here call it privatized banking here on the bottom left. Another company, Pamela Yellen, she does it, and she calls it Bank on Yourself. I've got a company and a website where I call it Be the Banker, so it's just different people call it different things, but it's all based around the same thing. And then this middle book here, What Would the Rockefellers Do? This one's one of my favorites. Garrett Gunderson wrote this. He understands, he's been a financial advisor for a long time. He understands the banking concept tremendously, and he talks about the Rockefellers Trust. So that's a great one too to show you from an outside perspective other than us talking about it. Would do really good for you. So I would recommend reading any one of these books. Okay. And I'm going to stop sharing if everyone has got the information.
That's awesome. So how would someone connect with you, get to chat with you further one-on-one, or look at maybe hiring you guys or whatever?
Sure. Yeah. The easiest way would just be to set up a call with me on my schedule app, and can you see my screen still, or did I stop it?
We can see your face now.
Okay. It's super easy. It's just jasonhill.co. So it's not jasonhill.com without the M. jasonhill.co, and you can go there and schedule a meeting with me. Sure. And then basically all we do there is a strategy session. You can ask some questions. I'll ask, about your income and, kind of how you're making your income and stuff. And then from there, I would design the cash flow analysis, put together the illustration, and then do a proposal for you. And then once I'm done with that, we would just jump back on another Zoom, and I'd walk you through the numbers just like we did a little earlier.
Okay. Well, that's awesome. So guys, maybe if you guys have any other questions you want to message in, or you could even unmute yourself now and we could chime in. And then if there's nothing else, we can bounce off. But I just want to give you guys a chance to use Jason or even Justin, because
ask away, please do.
Justin's famous in Milwaukee. Nobody?
No, I just want to say thank you. Now I understand more why. What's the other guy? The unknown guy. I wrote it down. I forgot. Justin. Sorry, Justin. Why Justin has more than one policy to make it more tax free. So thanks for all the explanation. I think it's a really cool product.
Okay.
Thank you. Yeah, I mean, I was really drawn into it. I mean, I've always wanted to help people with their money, you know, kind of deal. And the marketing was great. My business that I did for years, I loved helping businesses all over the world. It was awesome, but I still had that desire just to help the individual. And man, when I found this, I really prayed about this. My wife thought I was crazy. I prayed it before I knew anything about the banking concept. I learned how the banking system works in the US and how they basically print money from thin air. And I was like, I want to be able to print money from thin air. That sounds fun. I like that. So I just prayed about it. And I did a lot of research and found out you needed about $33 million of cash liquidity to start a bank. And we were a few million short, you know. So I was like, I don't care. I'm going to keep praying about it and figure it out. And then randomly, just one of my 5,000 Facebook friends made a post and said, hey, would you like to start your own bank? And I was like, you know, immediately like hitting the buttons, and we talked for like 2 hours on the phone. And then after that call, I was just like, man, I would love to share this with other people, because this, you know, I just feel a calling for it. It's like it's like a ministry for me and a passion. And, you know, it really changed my financial life. I've been super blessed and made a lot of money, but I was very good at spending money. I was a lot better at spending it than making it, you know, so all that money was gone. But just imagine here, if you had one of these banks and you were capturing all your income for the last 20 years, imagine, you know, what kind of position you'd be in right now. It'd be a world of a difference, you know?
Yeah, let's not think about that.
Maybe not think about that, but, you know, maybe for a second.
Well, you mentioned one thing I wanted to ask on. You said something about using the pre-tax dollars, right?
Yes.
And so is that essentially saying that I can take the money and put it in there, and then I can subtract that from my income that I'm like claiming? Or how am I using pre-tax dollars instead of post-tax dollars for this?
Okay, good question. So basically,
wait, let him go first, Sandra. Let him go first.
When you put the money when the money gets put in the trust, all the money will go straight to the corpus of the trust. Anytime the money's put in the corpus of the trust, there's not a taxable event, and it's not subject to the the capital gains taxes. But if you did a distribution,
it's not pre-trust money, it's only pre-tax money when it's in the trust.
Right. Yeah. So the money, you can't do it any other way. So that the money's in the trust and it hasn't been taxed, and then the trust can actually own the policies. So the trust will own the policy and pay for it with the pre-tax dollars.
Okay, Sandra.
So in the beginning, you will invest after tax money, but the more you have it, the more you can use pre-tax money, and you don't pay the tax on the money. So that's how you go from taxable to non-taxable.
I'm looking for a place to shove some pre-tax, pre-trust money right now.
Yeah. Yeah. So, if you start out a policy and you're the owner of the policy, there's no way to put pre-tax dollars in there. But if you have the trust can own the policy, and all the money that's in the trust would be pre-tax. You know, it hadn't been taxed yet. So then you could put it in the policy. And then when you take out the policy loan, that's not a taxable event. So there's no taxable event that ever happens that way.
Yeah, but that's after the trust is there.
Right, yeah. So if you want to do the pre-tax dollars, you have to have the trust. And the IBC is still a great policy, even if you're using tax dollars. You know, it's still a way better way for people to put their money to work for them than anything else I've ever seen. So that's just a huge bonus that we fell into. That's an extra bonus. You know, it doesn't have to be that way, but I mean, it might as well. We want to keep all the money that we earn, you know, as much of it as we can. So.
Okay, awesome. No, I just recently, like I told you, I'd been approached with this sort of concept with the IBC stuff before, but like there were holes in my knowledge base that just made me think, no, that seems silly. And plus, you know, Susie Orman always said, don't do it.
Right, exactly.
So, and so, you know, then I went through and I was going through like a course with someone and kind of that utilizes it, and I started being like, oh, okay. And so then I started, you know, then your thing popped up on our Facebook group, and I was like, all right, it was more selfish than anything. I wanted to it was more for me than like other people. I thought other people might want to find out more things too. So, but yeah, no, I really appreciate you taking the time to hop on here with us. And Sandra, Justin, thank you so much. You're obviously, I knew for sure that you had researched that, and you've read that book, haven't you? You read that probably.
Yeah, when you're getting rolling here, like you got to read one of these books. But there's a ton of people on YouTube that I follow that explain it as well. If you just type in infinite banking in the YouTube search bar, I mean, I probably spent hundreds and hundreds of hours on this, and so once you get in and start analyzing, you're like, man, this. When I was going to do my original policy, I was like, maybe I should do $10,000. And then I started looking at it, and then I was like, maybe I should do 30. Then I did 50. And then I'm like, I needed to put every dollar in here. But it was a lot of knowledge or a lot of learning and time went into that. And that's over, it's a little over 2 years it's close to 3 years when I first heard about it. So like, if you're getting into it, read the Nelson Ash one. That's like very, uses analogies to help explain it. Uses a grocery store to simplify it. So once you get that foundation, then when you see the policies, you can kind of help understand differences between policies, so that because when you sign up for this, it's not easy to change. So you're gonna want to make sure you put a lot of research into it before pulling your first one.
That's awesome.
What's really funny is today I just listened to the latest Bigger Pockets podcast, and it was Chris Noggle, I think it was.
I know Chris.
Yeah, and he alluded to it, like he was talking mostly about real estate, but he alluded to it, and then I went to like his website, and then he's part of what is it?
The Money Multiplier.
Yeah, the
Money Multiplier, right? And so I started kind of watching some of their webinars and stuff too. And it was just like, and then of course I had already kind of said I would go to this today. So it was just kind of funny that my whole day, like I've been listening to all this stuff about velocity banking or infinite banking, and, so it's kind of a funny thing that it's just like all hitting me at once, but yeah, trying to drink from the fire hose now.
And actually, I met Chris in February of maybe last year at a mastermind for IBC, and we were with the Money Multiplier. Josh Nelson, the owner of our company, he started out with them, and I started out with them, but we wanted to do our own thing and break free. And so that's what he started his own company, and he's been like a multi-level network marketing for like 20 years. He's made a ton of money and stuff, and he's a great leader. But Chris is a good guy too, and I learned a lot from Chris, because when I first learned I was still kind of new not totally new, but I didn't know all the concepts and how to use it. And I was asking Chris, how can I use pre-tax dollars for this? How can I go to businesses and be like, let's set this up as your retirement fund? So me and him sat down and talked about it for a long time, but we really couldn't find a way to use the pre-tax dollars and do it. And then we just happened to stumble upon the trust, and really what the trust does for us is it opens up the door to much bigger fish, to bigger investors that have the money, and people that are in real estate, crypto, just, own their own business because they have the money. They're paying hundreds of thousands of dollars in taxes and they don't want to. So.
Yeah. And, I watched the video you dropped a link on in the chat with Justin and I, and that may be something that you want to toss into in our thing after we get to the bottom of this. But
okay,
because there was some stuff in there. There were some infographics and basically kind of breaking down, kind of the flow of money and how the policies come together in the trust and that kind of thing. And some people are more visual learners and kind of help.
Oh yeah, I'm one of those for sure.
So
yeah, I'll drop that link. I'll drop the link for schedule in case someone wants to meet up and have a strategy session, and I'll drop that video too. And then anyone that's super interested in the trust, Richard did 2 trust videos for us where he breaks it down from A to Z. And he talks a little bit about how we combine it with the banking, but mostly it's just about the trust. And he compares, someone without it and with it. It's just really good video, and it comes straight from him. So
when I take this in this video and post it into the group, then we can post those links into the comments.
The comments,
and then they'll be right there. Same thing on
okay.
YouTube and that kind of deal.
Perfect.
Awesome. Awesome, Jason. Anything else, anybody, before we go? Okay. Well, Jason, thank you so much for the time in. I definitely picked up a lot from this, and hopefully some other people did too. Thanks, man.
Well, thanks for having me, Justin. Thanks for chiming in and just sharing your knowledge as well, making my job a little easier. And thanks for everyone taking the time to coming out.
All right,
Look
man.
forward to maybe talking to you in the future.
See you guys.
See ya.